everyone, my name is Courtney and I'm here with my colleagues Steph, Neil, Anthony, and Mike to discuss Rejuvenating Spa Inc. or RSI. Here's our agenda for today. We're going to start off with an internal environment scan. We've identified RSI's vision and mission. We'd like to point out the two common themes across these. So first off, RSI provides service that is client-centered and in using environmentally friendly and sustainable practices. We've also identified some key success factors that RSI must maintain in order to be successful in the industry. Currently, in terms of goals and stakeholder preferences, there's a general disagreement among shareholders with regards to the overall direction of the company, and the company currently lacks an overall strategy, so this is something that must be addressed. We've also performed an initial financial analysis. We've calculated the covenant ratios, all of which are currently being breached. So the interest coverage ratio is currently 2.6 for RSI, so no payouts can be made to shareholders until this ratio is greater than 10. In terms of liquidity ratios, you can see that the asset ratio and current ratio for both companies are below 1, indicating that current liabilities are greater than current assets. However, there doesn't appear to be a liquidity issue, as you can see cash flow from operations is significant and is positive. In terms of solvency ratios, RSI does have a significant amount of debt that they took on in order to finance the purchase of Lavish. So they are limited in terms of how much debt they can take on right now in order to finance future growth. In terms of profitability ratios, both companies have healthy profitability. They have high gross margins, and they've been able to manage their costs in order to maintain profit margins. For RSI, this is 27.2%, and Lavish, it's 8.9%. Now we're going to get into a SWOT analysis. So we've listed all the strengths here. One of the main ones is that RSI focuses on the health benefits of spa treatment. So this mitigates their risk in the event of an economic downturn, as people will focus on the health benefits rather than the fact that spa treatments are luxury goods. One of the main weaknesses is that RSI's prices are lower than the average spa, so they are forgoing potential revenue. Some of the main opportunities that RSI could take advantage of is there's a greater proportion of men visiting the spa, and there is a trend towards tourism-related spa visits, so RSI could target these people in order to improve their revenue. And finally, one of the main threats is that there's an increase in substitutes for spa services, as anything that people could spend their discretionary income on is a substitute for spa services. Now we're going to get into the 4 strategic options that RSI has available. I'm going to start off with strategic option number 1, which is the operational consolidation with Lavish Spa. So here's some of the main pros that we've identified of this option. The main one being the cost savings. So RSI and Lavish could combine their accounting and administrative functions in order to reduce their costs and increase their consolidated profitability. Here's some of the main weaknesses. The main one is that there will be downtime and training involved in joining the 2 reservation systems, so this will increase costs. We've also performed a quantitative analysis, so as you can see, the consolidated profitability is less than the individual profitability of each company. However, consolidated profitability will improve when the 2 companies take advantage of the cost savings opportunity that I mentioned earlier. And finally, there's minimal financing requirements with regards to this option, and there are no significant accounting and tax implications. I'm now going to pass it off to Steph to talk about franchising.
Thank you, Courtney. Now moving on to strategic option number 2, which is franchising RSI spa locations. So first, let's start with the major pros and cons of this decision. So one of the major pros of this expansion for RSI would be that they're able to target a larger market and expand in the industry while using franchisee capital rather than financing it themselves. It'll also allow them to build a reputable brand nationwide. Also, with experience from other franchisees, they'll be able to improve RSI operations. So now moving on to the cons. So some of the cons include seeing that different franchises will be owned by different owners. They could have differing values, which will damage the brand's reputation. So quality control may also be difficult for the company, seeing as they'll have so many locations. So it's going to be important that they have a lot of quality control processes in place. So now for a quantitative analysis. So if you look at the break-even point here, you'll see that for startup costs, they're around $250,000, And in order to break even for these costs, we're looking at opening around 8 locations. For ongoing costs, we're looking at about 5 locations that we'll need in order to cover these costs. So financing, so we'll need about $250,000 in the beginning to cover marketing material and operating manuals. We'll also need another $65,000 for first year's activity. There are no tax and accounting implications for this decision. So now we're going to move on to Neil, who is going to discuss the partnership opportunity.
On to strategic option number 2, which is the partnership with FFL. Looking at a qualitative analysis, pros and cons. For the pros side of things, there's going to be a big cost-sharing opportunity here in which RSI is going to be able to grow the way they're looking to grow without taking 100% of the risk, being able to share rent costs, among other things. Also, it's the perfect access to their target customer base, which is the health-conscious individual who is looking for spa-like amenities. Now looking at some of the cons, currently there's very limited brand presence for RSI in the agreement, which is going to need to be looked at. And furthermore, more due diligence is going to need to be done on FFL's financial performance, as it is incredibly crucial for the performance of the deal. So how does this fit with the mission and vision? Well, obviously RSI's vision is to become the reputable leading spa brand in Canada, and they're going to need to grow geographically to do this. And this partnership is going to enable them to do that. So we feel that it does fit with the mission and vision for RSI. Looking at a quantitative analysis, the startup costs that are going to be needed for this investment are quite low. They're under $50,000 at a projected $46,000, although this may involve more costs as it's looked into, including audit fees or legal or other matters that are going to need to be dealt with. In our projections, we have a total net income for the year of approximately $182,000, which leads to an ROI of 388%, which is certainly within the growth targets that RSI is looking for in this type of endeavor. For the financial reporting and tax treatment, there's going to be benefits including income splitting, which is essentially within the partnership. When either party has losses, they're going to be able to cover each other's losses, which is going to reduce tax payable and be an overall benefit for the future. Furthermore, incorporation should also be considered as both parties grow larger. This is going to provide many tax benefits for both partnerships in the agreement. It's also going to prove to be a reduced liability if anything were to happen. And furthermore, if RSI does include to buy out some of its share later on, it's going to create a much easier situation as opposed to a partnership agreement, which can get quite messy. So overall, we feel that this is a great fit with the mission and vision for RSI.
Our next strategic option is the purchase of Pure Substance Inc., a spa product manufacturer. In order to analyze this option appropriately, we need to look at how it aligns with management's mission and vision. From a product standpoint, the acquisition enables the firm to sell environmentally friendly products and aligns with its mission to serve customers in a sustainable manner. However, in terms of risk, the management team has no prior experience operating this type of venture, and the purchase of this company does not align with the rest of RSI's mission, which is to provide exceptional client-centered spa and therapy services. Thus, overall, there's a general misalignment with this option and the company's mission and vision. However, looking at the acquisition qualitatively, there are some strong benefits. This acquisition vertically integrates RSI supply chain, which will improve efficiencies and reduce costs. Furthermore, it helps the firm take a step forward in an industry trending towards environmentally friendly products and social responsibility. And finally, there is growth potential to expand into large retail chains that want to carry Pure products, which can increase sales. However, these benefits do come with some substantial risks. The industry itself is facing increased competition, which will put pressure on margins and increase production costs. Staffing is also an issue, as potential staff outsourcing will not align with the company's ethics and could reduce the company's overall brand value. Finally, the lack of management expertise could also lead to increased costs, as the management will not fully understand how to leverage the synergies of the acquisition. Thus, it ultimately appears as though the risks outweigh the benefits for this opportunity. Now that we have gone through all of the options, it's important to highlight the decision-making criteria and the rationale we use in our recommendations. When analyzing each of the options, we considered how the opportunity 1. Aligns with the strategy and mission, 2. Improves the brand, 3. Meets the growth targets, how it meets the constraints, and finally, how feasible the opportunity is. Thus, based on those criteria, our firm has recommended that RSI pursue the consolidation with Lavish, the partnership with FFL, and future franchising opportunities. Now I'll pass it off to Mike to discuss the implementation for these 3 strategic recommendations.
Plan for the next few years. In year 1, we're doing the consolidation of RSI and Lavish as well as a partnership with FFL. We're doing the franchising in year 2 with 4 franchises, and in year 3 we're expecting 8 franchises. Here's the breakdown of the implementation plan for the 3 options. For the consolidation with RSI and Lavish, we think Sally will be the responsible person, and we're expecting to save costs in general and administrative expense. For the franchising, we think having Sally with assistance with Emily will be a good candidate options. For Emily, she will be able to screen the good candidates as well as the location. And we're expecting to delay the franchising for at least 1 year just to see how the other 2 options are going. And we're expecting a $200,000 upfront cost in year 2, following a profitable year in year 3, given we will have 8 franchises in year 3. For the last option, we are thinking about having Lisa being the responsible person, since she has had a leadership experience in the past in the regional health department, as well as being the president of the school club breakfast. We think that if she's not interested in the position, we can use an external hire who will be neutral between FFL and RSI, so that RSI will not lose benefit from the partnership. And we're expecting a $50,000 upfront cost, and we're also thinking about starting with a partnership, and if everything goes well, we're looking to develop into a corporation in the future. In terms of the financial forecast and financing, we are expecting a $210,000 startup for year 1 from the partnership with FFL, and the $200,000 startup cost for the franchising in year 2. With the option of bank and Bear Commons for financing, we think that for bank, while the interest rate is low, the covenant is high, since we need to meet greater than 10 for the interest coverage rate, which means that we need to stop distributing our dividend until 2017. However, for Bear Common, while the interest rate is higher, the covenant is less strict, and with that we're able to keep distributing the dividend to our shareholders. And because of this, we think Bear Common is a better option.
Thank you, Mike. Now we're going to move on to the operational issues facing RSI. So one of the main operational issues that they are facing right now is their governance and corporate structure. So right now their board of directors lacks an individual with financial accounting background, and seeing that they will be expanding geographically, it's recommended that they do have someone with this background, as there will be a lot of external stakeholders looking at their financial statements. So we recommend that they give Blair this opportunity to sit on the board. In terms of their corporate structure, we feel that this needs to be clarified and they should keep current managers in place. However, give them more of an oversight role and reduce their day-to-day operational responsibilities. Right now, it's also noted that the business activities and operations of RSI are not aligned with the shareholders' goals and objectives. So we recommend a balanced scorecard in order to align shareholder goals with business operations. Administratively, right now there are 2 information systems being used. We recommend that they use the one information system, as it'll help streamline their administrative services and also result in cost savings for the company. In terms of the employee bonus scheme, right now it's not standardized across Lavish and RSI. We recommend that this be standardized and that they create levels, one for managers and executive level and one for staff below managers. And we also recommend that they keep the current structure based on revenue. Now that sums up our operational issues, and to conclude our presentation, we do recommend that RSI consolidate with Lavish, pursue the partnership with FFL, and also franchise out RSI brand. Thank you, and now time for questions.